this video, I'm going to show you the Skool model, my highest win rate entry model with a checklist so you can use it too. You can use this entry model to get funded, get payouts, and just skyrocket your win rate. I actually used this exact model to get my first funded account that eventually led it to over $1 million in funding and over 100K in profits. No time to waste. Let me show you how it works. The Skool model is a very simple concept. It relies on external range liquidity, alt highs and lows, and internal range liquidity. And the first step of it will be price trading towards a alt high or low. So in this example, a alt daily, weekly, or monthly low. We tap it, then we break structure, and we go from external range liquidity, alt low, towards internal range liquidity, a fair value gap. Vice versa for shorts. Price goes to an alt daily, weekly, or monthly high, break structure, and then we go to the internal range liquidity. The core Skool model is very simple. It's a daily high and low. It's a 5-minute structure, and we target a 1 hour fair value gap. So this example, this is a daily high, this is a 5-minute structure, and we target a 1 hour fair value gap. Same here, we target a daily low, 5-minute structure, and target a 1 hour fair value gap. You can use also weekly highs and lows, monthly highs and lows, and instead of a 1 hour fair value gap, you can also use a 4 hour fair value gap, but the core model is this, and you can mix and match to see which one fits your trading style the most. And a few extra notes here. We go from external range to internal range liquidity. That means you are trading from an alt high to a fair value gap. Most of the time that is counter trend, making it lower probability. But why not try to trade with the direction of the higher time frame and also use market maker models here. So here you have a buy side of the curve. We go to an alt high and then we start a sell side of the curve. Market maker model, smart universal. If you're not sure what a market maker model is, I've dedicated a video to market maker models here on this channel. And let me share some extra secret sauce here. So remember this framework. Let's say with the rule here, trading with the higher time frame trend is better with the Skool model. Cool. Let's dive deeper here. Let's say we are here on a daily structure. So we are going up and up and up, and we create a daily bullish fair value gap here. Fair value gap looks like this: candle 1, candle 2, candle 3. Let's break this down. Daily bullish fair value gap has candle 1 high, it will be right here, candle 1 high, candle 3 low. So here you have an alt daily high and an alt daily low basically. But what if we can play the Skool model in this candle 3 low that is overlapping with a daily bullish fair value gap? Remember, we want to trade with the higher time frame trend. So once we trade into here, we not only take a daily low, start the Skool model, because we trade from daily external range liquidity to internal range liquidity. This is going to be a very small trade, of course. We're going back to a, let's say if here's a 1 hour fair value gap. This move will be the Skool model. You don't need to catch all the big moves. You just want to be a thief in the market, going in and out very fast and make your money. So when you have an overlapping Skool model, daily low, towards internal range liquidity, overlapping with a daily bullish fair value gap, there is where all the money is, and there is how you can trade with a higher time frame trend. That is why the higher time frame for buys is so important. So yes, you trade from external range liquidity to internal range liquidity, but maybe you can use a daily structure to trade in line with the higher time frame trend. And let's say this is a higher time frame daily high. Of course, you can trade from external range liquidity back to internal range liquidity, totally fine. But the highest probability trades are with the higher time frame trend. So you can use this framework to play along. Daily high and low, 5-minute structure, 1 hour fair value gap, external range liquidity to internal range liquidity. And here in my free Skool group, I not only share all my trade ideas and new frameworks I'm sharing, here you can also learn the exact Skool model. You go to Classroom, go to Start here, and there you have a full mini course, among other things, the entry model. So to make your first trade, you need 2 things. You need a location and you need an entry model. And the entry model is the Skool model. So go here in the Skool group, watch the entry model, and not only this, I have listed 30 examples of this exact model of actual trades I took. So right here, part 1, Skool model, literally trade executions on Twitter with the exact screenshots attached to it. And I won't bore you with all the examples, but just know that there are 30 examples right for the taking, where you can just look at this, back at this with real-time executions. And now you know how the model works and that you can find more examples in the Skool group. Let's look at some examples right now, breaking it down. This first example, look at NASDAQ at the 1 hour chart. And remember, this is what we want to see. Daily high low, 5-minute structure, 1-minute fair value gap. And in this piece of price action, we just have a massive move upwards here on the 1 hour chart. And before we go upwards, we're never going up in one way. if we're going up, we're always retracing. We're always retracing before going upwards. And same here. I'm expecting price to go up. But before go up, I want to retrace in at least this fair value gap. Even this fair value gap, or maybe the order block here. But this is the low-hanging fruit target. So the Skool model is played around this. So here we are at Thursday at the New York session. And Wednesday high is already tapped early in the day. So let's go to the 5 minute to see how this looks like. So here on the left, we see Wednesday high, right there, the Asian session, and it's already tapped at midnight. So the first step, the daily high, is already taken. I don't see very active displacement in the London kill zone. Most of the time, NASDAQ moves in the New York session. So I'm expecting the entry to be in the New York session. So I'm skipping the London session. I come back at 8, 9 a.m. Ideally at the open, 9:30. So let's see what we do at the open. We have displacement here from 8 a.m. But the structure is weird. Like we have a very small liquidity sweep right there, but you don't break down as much as like this price is a little choppy. So I'm waiting here. And if you already take your first entry, like let's say you want to tap it into this volume balance right here, stop above the high. Right here, you would have been stopped out, and that's fine. I rather wait for more clear structure later in your session when I see this kind of moves. So right here at 11, we started to move up and then aggressively start moving downwards. This is the structure I would like to see. And why I want to see this, like here, if we draw this out, it's a consolidation. Little liquidity sweep and then breaking down. If we see this, we have go lower and lower, aggressive buys, aggressive sells. This is the model, the market maker model I want to tap into. Like this structure is not too aggressive enough for me. So this is what you always want to see. Remember, the framework, this is what you want to see. So if we copy this to a structure right there, this doesn't look to me like the structure. This looks to me like the structure. So let's see what we have. We have a 1 hour bullish fair value gap as a target. We have multiple fair value gaps. So there's all that question of which one do you pick? And when I have multiple fair value gaps, I like to take in the first one, ideally in premium for a short, and then let my stop loss cover the rest. So in this case, I would take my entry order here at 12 at the lunch. It's a little outside the kill zone. So probably gonna need to hold this towards the PM session. Target the fair value gap, the 1 hour fair value gap for a 1 to 2. So my stop loss now is allowed to trade into that upper fair value gap. That's nice. Yes, you are in drawdown. You're not at that sniper entry, but this is the Skool model. You don't want to be in, you want to make money. So let's see what price gives us. So we have a first nice reaction, but then we come back into the PM session. Looks nice. And here is where most traders panic. Because, oh no, displacement against your position, but you have a Skool model on your hands, daily high, market structure to the downside, and price taps into the top fair value gap 2 times, and then starts to break down towards the target. So, as expected, price could trade it to the top fair value gap. It did. So yes, you're in drawdown, it's uncomfortable, but this is how the Skool model works. And as the next example, we're looking at AUDUSD on the 1 hour chart. And this Skool model works on both Forex, indices, gold, crypto, it works on all of them. So here we see we take out Tuesday low, right here, and also Wednesday low. And we are at Thursday, where in a kill zone. We're approaching London kill zone. So let's drop to the 5 minutes with daily low being swept with a 1 hour bearish fair value gap. That's the target. Now let's see if we can find a structure to the upside. So what you want to see is price taking out the low, breaking structure, fair value gap, order block breaker to the target. Here you want to enter. That's the goal. So let's see if we get that. Price, aggressive sells, aggressive buys. Awesome. This is great. This is exactly what you want to see. So let's wait for a fair value gap. Fair value gap created. Awesome. So the trade will be like this. Here's your entry. Price should allow to come back into these fair value gaps. Target 1 to 2, ideally overlapping with the fair value gap. You also can go deeper into the fair value gap, but if you can get a 1 to 2 like this is awesome. If you want your stop to cover the low, can be, but then your trade needs to be bigger. That's up to trader discretion. I like to take it like this. So let's see what price gives us. And we go to the target without a fill. So it can happen. You're the right side of the market, but you miss a trade. So in this case, you just miss a trade, you go back to the drawing board and you just go out for the next opportunity. If you drop one time frame lower to the 1 minute to see if there was an entry there, well, here in this move, there was no entry, it was the fair value gaps. Fair value gap here did not get tapped. The fair value gap here did get tapped, but this created the 5 minute fair value gap. So either way, 1 or 5 minutes, I wouldn't be in. So this is just a missed trade, journal it, and up to the next one. Here we're looking at ES at the 1 hour chart. And what do we see? We have a big, massive displacement right here, and we just rebalanced. And Remember what I mentioned about the higher time frame trend. If you want higher time frame trend, you want to go long, but it would be nice if you can long in a daily fair value gap. And daily fair value gap or fair value gaps overlapping with daily lows. Well, in this case, what I showed you right here. So if you have daily lows overlapping, you can use the Skool model in your favor because you already take out daily lows and then continue the trend to the upside. That's what we're going to do right here. So here we have a Tuesday low, Monday low, and Friday low. 3 daily lows, 3 daily sales and liquidity pools being taken out. And then we trade into the 1 hour fair value gap. So already your trade idea is activated once we hit one of these lows. You just wait for a 5-minute structure to form. So price trades lower, no lower. What time is it? It's the New York kill zone. We have the open here. And here is no displacement, right? There's no fair value gap. We trade even lower. And here I see aggressive sells, aggressive buys with fair value gaps. Awesome. So we have 3 daily liquidity pools taken out, aggressive sells, aggressive buys. So the trade's going to be in the fair value gap. We have a 1 hour bullish fair value gap here. I want to allow price to come back into this 5-minute fair value gap right there for 1 to 2. And then let's see what price gives us. Taps into it and then trades higher towards the TP point. And you can even refine this entry. And if you see my previous video breaking down the A+ setup, you recognize what's happening here. Here the example was from internal range liquidity to external range liquidity, from fair value gap to an old high or low. But these exact rules, a liquidity sweep in a key level, the key level is in the Skool model, the old high or low on the higher time frame, the old low. When we have that old low, you wait for the market structure shift, price coming back into the fair value gap order book breaker, ideally in premium discount or the OT area, and the tap into the old low is inside the kill zone. And then your drawn liquidity is in the Skool model, a old 1 or 4 hour fair value gap. A+ setup from external liquidity to internal, and vice versa now from internal to external. If you have a 15-minute level, and yes, we have the Skool model here, but you have also an overlapping A+ setup here. So here's the Skool model, but here we are trading into a internal range liquidity pool. That means a fair value gap, 15 minutes to 1 hour fair value gap. 15-minute level, you can go to the 1 minute to find your entry, internal to external. External range liquidity would be right here. So this would be the Skool model entry. Let's see how you can frame an A+ setup around it as well. And I think you can even get a better entry. If we look here at the 1 minute, aggressive sells, aggressive buys, you have a market structure shift right there. Fair value gap 1, fair value gap 2, you could take your entry right there. Fair value gap 2, stop below the low. And your target would then be from internal to external for 1 to 3. So here you are with the Skool model, you're a little thief in the market. With the A+ setup, you could have taken a bigger trade, bigger stops, bigger TP. And price eventually hits that target. So here you have both an example of the Skool model and the A+ setup. So no matter which one you like to use, they both work. So here you have it, the Skool model, going from external range liquidity to internal range liquidity. Use this model to go to the chart, execute it, backtest it, build data so it works for you. In my free Skool group, I have the framework with 30 examples lined up on top of a complete course, so you can go from 0 to profitable very fast. And if you like this video, consider liking and subscribing, and then I'll see you in the next one.